I'm very fine. Thanks for having us. Thanks for giving us the opportunity with this very illustrious circle to share the perspective of a credit insurance company. Thanks for giving us the opportunity.
Okay, super, super. Yeah, so I'm curious about your insights. How do you see the economy? How do you see the risks? And what will, in your opinion, happen in the next months? Please go ahead.
Sure. Yeah, I've prepared a short presentation by ways of introducing the topic, and I've been asked to share with you guys the view from a credit insurer's perspective, what the impact of the crisis has been, and as Robert said, what our view on the economy is right now, and the perspective and which aspects are impacting us as a credit insurer. I'm, as Robert said, I'm Andreas Tesch, Chief Market Officer of Atradius, responsible for our commercial activities worldwide. All of you, I guess, are familiar with credit insurance as a tool. Some of you are using it. Some of you are even using it with Atradius. Atradius is the second largest credit insurer worldwide with a global market share of 24%. And in that capacity, providing support to you as credit managers as much as possible in terms of analyzing risk and giving you insights into our view, but also to protect you and your companies against the unexpected losses. And I think it's fair to say that the outbreak of COVID has been one of these totally unexpected events that have hit companies that, as mentioned earlier, were probably from a financial perspective, from a financial analysis perspective, incredibly healthy, but given that they were operating in sectors that are heavily impacted, get into trouble very rapidly, something that no credit manager and no credit insurer, in fact, could have predicted. If we can move to the first slide, please. I'd like to set the next couple of slides a bit into perspective. All these numbers are in some shape or form familiar to all of you. But what is most striking is not the fact that we are now looking at a global recession, that we're looking at an even more severe recession for the Eurozone. But if you look at the speed of deterioration and the speed by which you as credit managers, corporates, and we as credit insurers had to adjust, because the immediate impact of that reduction in GDP has been the increase in insolvency. As you can see on the bottom right, we look at unprecedented expected increases in insolvencies in a number of markets, most prominent in the US, but also within Europe. We've plotted some examples of how steep the increase of expected insolvency is going to look like. Germany, in our assessment, being one of the few companies that will see an increase in insolvency, but not as severely hit as a number of other countries. What is important is that you have to distinguish not just by geographies, but particularly by industries. Within industries, of course, you need to distinguish between the individual corporates. I recently heard next to the very well-known V-shape, U-shape, W-shape, about a K-shape. And the K-shape basically indicates that the one leg of the K is going steeply upwards and is going to provide most industries with a rapid improvement. But there are other industries that are on the K leg that points downward, and that will probably continue for the foreseeable futures. Industries like entertainment, like tourism, they have been, and they will continue to be severely hit, and they will be part of that part of the leg. But the good news is that the upper leg of the K, and that is one of the assumptions today, is showing a rapid improvement. Only very recently, I've spoken to a steel producer that is already for now in November, December, looking at an order book that is as big as it has been 2019. While they still expect for the full year a revenue deterioration of around about 20%, it appears that the second half of the year is indeed pointing at a strong recovery, as everyone has hoped and some have expected as well. We can turn to the next slide, please, to go a bit more in detail as far as the geographical differences in global insolvencies is concerned. First of all, we need to bear in mind that the countries are looking at a different starting position as far as insolvency numbers are concerned. And when looking at those countries, you can see that on average, we as Atradius are expecting an increase of 26%. But there's a huge variety looking at individual countries. Again, Germany being at the bottom, with Turkey, but only or already in the second position, a substantial economy like the US with increases of around about 40%. It's fair to say that in the first half and after the outbreak of the COVID crisis, we've not yet seen a, uh, um, a deterioration in that order of magnitude. We've seen some increase in insolvencies compared to last year, but nothing of the magnitude that we are expecting and anticipating for the full year. And that is due to a number of factors. A lot of governments have taken severe actions in order to support economies, in order to support companies that have been impacted by the COVID crisis, and have kept some of these companies alive. And there's this famous saying of the zombie companies, companies that have been in financial distress even before the COVID outbreak, and that have been heavily hit and are still being kept alive by some of the government measures. Next to that, in some European countries, we've had a change or an amendment in insolvency legislation in that bankruptcy declarations have been delayed and will probably be further delayed until the end of the year, even though the criteria for declaring bankruptcy have been fulfilled. All that has led to what I've mentioned earlier, to a situation where we are not yet confronted with that tsunami of insolvencies, but we're expecting this to happen in the second half and probably continued in the first half of 2021, also due to the fact that some, if not most, of these government actions will expire. So what does that mean for credit insurer or for Atradius in particular? We move to the next slide, please. I want to bring your attention to three pillars that I want to talk to a bit more in detail. What's key for you as credit managers is also how we as credit insurers are looking at risk and how we assess corporates in the current COVID environment. The starting position, of course, is a healthy credit portfolio, and I'm going to talk to that in a greater detail. But what has been of utmost importance at the beginning of this crisis was to identify the most vulnerable sectors and those sectors that will suffer from a knock-on effect in this crisis. Due to that, we've changed the parameters of our underwriting, and I'm going to talk to why and how we did that in greater detail. And it's been crucial that we execute necessary measures in adjusting, reducing our credit exposure in a coordinated manner. And that leads to the second pillar, which is to act in a very customer-centric way. It's been our ambition as a trade is to minimize the disruption to our customers, to still understand our customers' needs in terms of which buyers they anticipate to be continuously strong partners within the crisis and after the crisis, and still support the customers for such buyers. Always remain in close contact with our customers and brokers and communicate in a very intensive way, but also, and that will be music to your ears, to rely on the customer's credit management capabilities. As an underwriter, we do underwrite our credit risk, but we, in the first place, also underwrite our customers. We distinguish between those customers that are using credit insurance as an outsourced tool and customers that are actively managing their credit risk, but they'd like to have a second pair of eyes, and they'd like to have an insurer that protects them against the unexpected, something like the COVID crisis. And given the severity of this unexpected event, this brings me to the third pillar, is the fact that governments have identified credit insurance as instrumental in keeping economies not just alive, but keeping them in a growing and a prosperous way. Um, so credit insurers have gotten engaged with the European Commission, but with individual European governments as well as with some governments outside of Germany, and we've negotiated and agreed on a couple of arrangements that help us as credit insurers to protect, to stabilize the business of our customers and thereby to stabilize local economies. It's important to stress that the rationale of these schemes is not to bail out insurers, is not to help insurers. It's basically to help companies to keep on trading, even in a very, very uncertain environment where, as a private credit insurer, we would be forced to adjust our levels of cover in order to keep our business in a sustainable way. That would have impacted our customers in a severe way. That is why these government schemes have helped us to continue supporting our customers. And I'm going to give you some more details in the presentation further on. So if you could move to the next slide, please. Just to elaborate a little bit on the risk actions that we've taken. First and foremost, we had to adjust our exposure, as I said, on the most vulnerable sectors first and foremost. The way that Atradius has carried out this action has been well received in the scheme of things by our customers and brokers. And I'm saying in the scheme of things because no one's happy to even discuss, let alone accept reductions of cover. But the way that we've conducted this action was in close coordination and in close cooperation with our customers. By first of all asking them about the utilization of existing credit limits and bringing cover levels down to the utilized levels to start with. But secondly, we also had to take actions on those corporates and those sectors that have been heavily impacted. What's been crucial was the coordination with customers, the timing, but also the way that we've approached our customers in adjusting that portfolio. To give you just an impression of the magnitude of that action, Atradius is monitoring 2 million buyers worldwide in our credit portfolio, and you will appreciate that whilst we have a whole host of underwriters and analysts that are performing those exercises manually, we are processing 66% of our credit limit decisions automatically. And it's 260,000 decisions that we are taking on a monthly basis. So this huge process, or this important process, had to be adjusted in a very rapid way. And we had to be very targeted because we didn't want to catch all birds with one stone. So you can imagine that the March and April actions have been very severe for our organization, also in light of the fact that people had to work from home. But fortunately, our IT was geared up to allow people to work from home and to take all these actions from their home office, still in a very coordinated way. As I said, communication and cooperation with our customers has been crucial and still is today, because there are ongoing risk actions that have to be taken. We are agreeing payment plans, debt restructuring almost on a daily basis with our customers wherever that is appropriate. And by doing so, we help our customers, help corporates to steer through this crisis. But as I said before, what is also crucial is that more than 50%, once all agreed government schemes are rolled out, are under protection by a given government. Under protection means that almost the whole portfolio would be fully reinsured by a respective government, but still governments are asking us as insurers to manage taxpayers' money in a wise way, i.e. not to provide cover on companies that are not sustainable even before the COVID crisis, and companies that have entered into financial trouble, would have entered into financial trouble even without the COVID impact. If we could move to the next slide, please. As I said before, the quality of the portfolio at the start of the crisis has been crucial. And when looking at Atradius, we've always been enormously prudent in assessing our risk, and we've been very conscious of the expected deterioration in the global economy. Still, our rating models had to be recalibrated, and we had to take into account different factors than what we would have done under normal circumstances. As we've heard earlier, a balance sheet or a financial statement in today's environment is of lesser importance, if of any. What matters the most is liquidity, and the expected level of liquidity for customers, which is why it's been crucial to keep information on our buyer portfolio as up to date as possible. And that's also where the risk manager at our client side come into play, because while we've obtained a lot of information from the buyers directly, we've also made use of the credit managers within our customer base. We acted very close to the risk by having underwriters present in 39 countries. And that's important because what has come into play even more strongly in the current environment is the importance of country sovereign risk. As I've alluded to earlier, we're looking at a very different pattern in terms of the various geographies, the strength of the COVID impact. On top of that, we've had the oil crisis in the midst of the COVID crisis as well, which has impacted places like the Middle East, like Russia, and a whole host of other impacts, the US-China crisis. So it's been important to factor all this into our reviews as well. We have also made sure that there's coherence between our commercial and our risk strategy. We've been very cautious and careful in our new business approach, while still being open for new business, because you can expect that in the current crisis there's been a lot of demand for credit insurance, even from companies that have not been insured before. And some of those companies obviously came at the wrong moment with the wrong portfolio. So as Atradius, we made sure that we service our existing customers first before taking new customers on board. But we are also adjusting our risk appetite in order to make sure that there is room for bringing on healthy new business as well. But in the first place, we try to help and support our existing customers by maintaining as much as possible existing credit lines, and even increasing where necessary, also bearing in mind the upcoming Christmas period. So if we move to the next slide, just to give you an illustration of how our appetite has changed since the beginning. While we were in the lower part of 70% risk appetite, and risk appetite is defined by level of cover that we provide in relation to the level of cover that has been requested by our customers and prospects, and that's on a global scale. This has reduced to a level of below 65% in the current environment. While you can see a steep decrease, this number has stabilized now throughout August. August usually is a very low month in terms of new applications anyway, but it's increasing again. That the current level of appetite is appropriate for the current environment. Also on this slide, you find the reference to the expected increase of claims that has not yet been visible. Claims ratio, nevertheless, have increased also for Atradius, where we've traded around 45% by the end of last year for the full year 2019. Right now, we are looking at a level of around 50%, so 15 percentage points increase. A large part of that is driven by provisions that we've built in order to prepare ourselves for the expected inflow of claims from our customers in the second half. The feedback we've received is that we've managed this crisis in a much better way than 2008, 2009, so that we've learned our lessons from what went wrong during that crisis. And what went wrong in the first place, as I alluded to earlier, was the quality of the portfolio, which has been far better when we entered into the COVID crisis compared to 2008, 2009, but also the intensiveness of communication. If we can move to the next slide, please. And that, as I said, I think is important for you guys, particularly because we don't look at credit risk and buyer risk in isolation. We always look at this in conjunction with the capability and the quality of our customers to manage risk. Particularly in such a crisis with very rapid developments, it's important not just to rely on our own capabilities, but also to have a trustful relationship with our customers. And you see a couple of bullet points that are crucial for us and that are crucial in our discussions with credit managers today and what we expect from credit managers in today's environment, next to analyzing balance sheets and profit and loss accounts, which they are doing in any event, which is what we are doing as credit insurers as well. And that, of course, is to monitor payment behavior as one of the indicators of creditworthiness, but also the changed level of trade. I've mentioned the steel customer that I've met recently. Their revenue fell off a cliff in the COVID crisis, but is now improving again. Order book is improving, so there are positive signs and there's light at the end of the tunnel. Whether that's sustainable for 2021 is still to be expected, but at least we see signs of improvement. That's what we would expect from you to monitor on your client side as well. But also, which actions are your buyers taking in order to counter the crisis? Is there government support available for those buyers? And what's their position in the supply chain, and to what extent are they impacted potentially also by a disruption in the supply chain? If we can move to the next slide, in the interest of time, I'm going to speed up a little bit. The last point of the three pillars are the government schemes that we and our clients are benefiting from. Those schemes have been developed in conjunction with respective governments, but also the International Credit Insurance Association has had discussion with the European Commission in order to secure as much as possible an alignment European-wide, which is important for us as insurers, but also important for globally trading companies. The crucial point is that for now, those programs are limited until the end of 2020. Most programs are governed by a European legislation, which expires 2020, under which the local programs have been built. Some have had country-specific approvals, but on a country-by-country basis, we're now entering into discussions with the governments as to whether and to what extent those programs should be extended into 2021, bearing in mind that we have not yet seen the worst part of the insolvency increases. If we move to the next slide, just very quickly to explain how challenging those schemes are from a credit insurance perspective, and also to manage expectations of customers to some extent when there are different decisions coming out of different customer countries, because the way that we underwrite a buyer is, as I said before, close to the buyer. So the underwriter is looking at the buyer's perspective to a large extent, independent from a customer once we've onboarded such customer, and therefore also to some extent independent of whether government schemes are in place or not. So we had to change our processes and our systems in order to be geared up to reflect these different schemes, which has been an enormous challenge, and sometimes still mistakes are happening, which we try to repair as quickly as possible. And again, feedback has been very positive, how Atradius has responded to that challenge also in relation to our competitors. Next slide is showing you the overview country by country, and it is rapidly changing. One of the countries mentioned under expected schemes, but ongoing negotiations is Poland. Poland, by now, we do have legislation in place, which now need to be translated into concrete actions. So this one has moved basically into an agreed scheme with the government, but execution still has to happen. And as you can see, there are also a number of countries where we are still in discussions, and there are countries where we cannot expect a scheme to be in place the course of this year and probably also not for the years to come. And there are some differences, as some of you might know. France has been the first country to announce a government scheme very much based on the top-up scheme that was agreed 2008, 2009. And only later on, they've also introduced a full-fledged reinsurance scheme as introduced in countries like Germany, Netherlands, Belgium, and a couple of other countries, in order to reflect the necessity to protect the whole portfolio rather than just some individual names. So there's quite a variety of schemes in place, but I must admit that I'm very impressed by most governments and the way they've identified credit insurance as a crucial tool to support economies. If we can move to the next slide, which is the last slide and provides the summary. As you know, we're still in the midst of the COVID crisis, and the worst part is probably still to come. Also bearing in mind the expiry of government actions, claims and insolvencies are still on the rise, so we all need to be prepared for that. And therefore, it's crucial for us as insurer to stay and continuously stay in close contact with our intermediaries, brokers and agents, as well as with our clients. We try to follow our customers' approach as much as possible and minimize disruption wherever possible. We keep monitoring and we keep adjusting our assessment strategy, adapting to the rapidly changed situation. We will continue to rely on you and your capabilities as a key asset for us as insurer, and we will continue to stay engaged with governments in the interest of our insured, not just in the interest of as insurance company. I hope this has given you a good insight into what's happening on the credit insurance side, what's happening also behind the scenes for us as an insurer in working with you, with some of you. And that might also intrigue some that have not yet used credit insurance to at least look at that as an opportunity. And I'm happy to continue discussions also on risk management strategies going forward. So with that having said, I finished my presentation and I'm happy to join the discussion further on.
Thank you, Andreas. Thank you, Andreas, for this great insights. I think from a credit insurer perspective, I think what is important is this individual approach, and this is really appreciated, at least from what I hear by the companies. And as well, this is important when we are doing our credit analytics to look at the companies very individually, which is hard, right? Because normally the portfolio is pretty wide. But this individual approach, if we like it or not, it's have to be implemented. But just one question maybe to you, Andreas, from your perspective, let's say, and personal experience, is this crisis different? And if so, how is different to the last one from 2008 to 2009? Is there any differences?
Well, it's very different. Yeah, that is very different in many ways. And I think first and foremost, this crisis has started with a corporate crisis, while the last one has started as a banking crisis. A potential knock-on effect on this corporate crisis is going to be a banking crisis, because already today we're looking at very high potential defaults in terms of number and size that will impact also the credit books of some large banks. So in that sense, that is very different, which has also triggered a different behavior of governments. and governments have responded much more rapidly to this crisis, trying to come to the aid of corporates than what happened 2008, 2009. I think the one similarity is the speed of the crisis. All of you will remember the day when Lehman collapsed and the speed of deterioration followed thereafter, and we've seen something similar with the outbreak of the COVID crisis. Only, as I said, the main difference is the response. I think after the Lehman collapse, no one was really, including governments, was really sure how to respond to that. There was a conscious decision to let Lehman go and probably also let other banks go. Right now, I think the whole world is conscious that this is an external factor which has impacted corporates, some sectors more than some others, without any misbehavior or mismanagement on their side. If you look at the airlines, for example, I mean, some airlines have been in trouble before this crisis. Some others have been managed in a very professional way, have been considered blue chips, and still they're on the brink of bankruptcy without government aid. And that has been identified very rapidly and has been attacked very rapidly by the government. So I can only compliment them for their actions so far, but their abilities are also limited. I'm very glad to see that a lot of the payment plans that we've seen with our clients are being adhered to. I must say my personal fear has been that those insolvency numbers and those default on receivables would have happened much quicker and much more severe than what we've seen so far. And I still have some hope that it's not going to be as bad for the second half and the first half 2021 than what we might expect at the moment, because it has also created a lot of unity between customers, suppliers, various parts of the value chain of society. And that was different in 2008, 2009 again, where the blame has been on the banks, on the financial institutions. Right now, it's very different also in that regard.
Yeah, thank you very much.